Okay, welcome to tonight's this evening's webinar presented by the Global Market Desk from Phillip Securities. And just to recap, this is a bi-weekly US Market Outlook webinar. So the previous webinar was done by our Phillip Research, which also presented on the sector outlooks and also technical analysis on some of the counters. So for today, we will be presenting on the US market outlook by our own night desk, Mr. Roger Chan and myself, Ming Jun. Okay, and I will be your moderator for today. So for questions, you may post it under the Q&A tab at the bottom, which you can post it along the way, and then we will only answer it at the end of the webinar. Okay, so for now, I will pass on to Mr. Roger Chan for today's market outlook webinar. Roger, please.
Okay, hello everyone. Welcome once again to the US Market Outlook webinar presented to you by PhillipCapital. My name is Roger Chan. Thank you so much for joining us. So without any delay, let's get into what we will be presenting tonight. We will first look at some macroeconomic events, okay, that happened recently. Okay, and then we will then take a more detailed look at a market phenomenon known as the inverted yield curve and why such a big deal was made about it when it occurred recently, right? I'm sure if you followed the business news, you wouldn't miss it. Inverted yield curve was a big thing, okay, past few weeks. Next, we will have some ETF ideas for you. And we hope you will like it. And after which, Ming Jun will be presenting to you the technical analysis portion of this webinar. Lastly, we'll then end with some Q&A. Okay, so what happened recently? Let's take a look. Okay, first up, we have the FOMC meeting last week. The Federal Reserve made a second rate cut by 25 basis points. And Powell mentioned that the US economy remains strong and unemployment low, but there are risks to the positive outlook. More extensive sequence of rate cuts could be appropriate if the economy continues to weaken. And of course, you have President Trump tweeting, Jay Powell and the Federal Reserve fail again. No guts, no sense, no vision. A terrible communicator. Stocks initially fell on the announcement, but it ended up higher on the day. So it suggests that this is in line with investors' expectations. So the Federal Reserve still refuses to commit to the start of a series of rate cuts, and they prefer to continue to watch things carefully. Well, this is because there are a lot of mixed signals currently. Businesses are hiring, and consumers they are still spending, but the ongoing trade war, the Middle East tensions, and the prospects of a messy British withdrawal from the EU are concerning. So next up, we have the US-China trade war. So right after China backtracked on a draft deal with the US, they tried to restart the trade talks, right? But after it was unsuccessful, a series of tariff threats were made by both countries. You had President Trump announcing 10% tariffs on top of the 25% already levied. And of course, you have China responding by stopping purchases of US agricultural products. And China's yuan currency weakens past the 7 per dollar level. This sent the equity markets were sharply lower, okay, when this happened. And finally, on the 4th of Sep, which was the beginning of this month, they both agreed, China and the US both finally agreed to hold high-level talks next month in early October. Okay, since then, China, has made some goodwill soybean purchases, and Trump has agreed to delay his next round of tariffs until the 15th of October. So we do hope that things eventually will be resolved, and we just will have to monitor to see how it progresses. Okay, and lastly, we have the Iranian conflict. Okay. Saudi Arabian oil facilities were attacked on the 14th of September. The Houthis, okay, the rebel fighters in Yemen, they claim responsibilities, but really suspicion was on Iran because everyone believed Houthis wouldn't have the capability to launch that kind of attack, okay, on Saudi Arabian oil facilities. Of course, you have Iran denying responsibility, and it escalated tensions in the Persian Gulf. It drove oil prices up by 10%. Saudi production dropped by 50%, but has since recovered. President Trump again vowed further new sanctions, and the investigation continues. Okay, so now we will have our second poll. Okay. Okay, right. And how high will crude oil prices go before the year end? So current price about about 58. How high do you think it'll go? Okay, so give us your views, give us your votes, and we'll see how it goes later. Okay, so we'll continue on. Okay, so last month, a major red flag for a recession went up. Okay, specifically, the rate on the long-term bonds, okay, the 10-year treasury bonds, the yield, the interest rates fell below the rate on the short-term bonds, the 2-year treasury bonds, okay. We follow the 210 yield curve because this is the most widely followed curve, the yield curve, okay. So we will be discussing more on this. This market phenomenon is known as the inverted yield curve. Okay, and the last time the curve inverted was in 2006, just right before the 2008 financial crisis. And it was big news on the media. Okay, here you have Time reporting it's all doom and gloom. Okay, a key indicator of the recession just triggered in both the US and UK. And Fortune reporting, are we near a recession? It's code red. CNBC reports, okay, yield curve will lead to a recession, and you have a picture of everyone calling out, trading aggressively, bond market sending recession signals. You have Yahoo Finance flashing red for the first time, the recession indicator flashing red for the first time since 2005. Okay, and you have picture of the Dow Jones falling as well. The S&P index fell 3.5%, okay, when the news first broke. And you see the next 2 days, it progressively trended downward. So it was a big fall for the S&P index. The Dow Jones index, same thing. Initially, it plunged, and then progressively it drifted downwards for the next 2 days. And in total, it fell about 3.6%. So you get a general sense that there was a lot of fear in the markets. Okay, everyone was fleeing for the exits because of news on the inverted yield curve. So this leads us to the next question. Is a crash imminent? Is a crash going to occur now? Because the inverted yield curve has just happened. Okay, before we answer that question, okay, let's have a little trading 101 on the US Treasury yield curve. Now this, I have here on the screen a picture of what a normal yield curve should look like. Okay, now you have the maturity, the number of years, okay, so it stretches from 5 years, a 10-year bond, a 15-year bond, 20-year bond. A higher duration bond should naturally yield higher than a shorter term bond. So for example, if I'm holding a 30-year bond, I should get more interest rates than if someone was holding a 5-year treasury bond. This is to compensate for the higher risk of holding that bond for a longer period. You have reduced flexibility, you're holding it for a longer period, and naturally there's more risk built in. So that's why I need to be compensated more by getting a higher interest. Okay, right? Sounds logical. And on a normal, regular day, this is how it should look like, okay, in normal circumstances. When you have an inverted yield curve, it looks a little bit like that, okay? The shorter term treasury bonds actually yield more than the longer term bonds, okay? So this this is an anomaly. Okay, this is not natural. Okay, so basically, if I held a longer term bond, I'm getting paid lesser in interest rates than if someone was holding a short term bond. So the next question is, why does an inverted yield curve happen? Oops, sorry for the double typo there. Why does it happen? Okay, now why do investors buy longer term bonds? Okay, when you have the longer term bonds dip much lower than the shorter term bonds, it is because investors are buying into longer term bonds. Okay, so this caused the price of the long term bond to rise. And what happens is the yield subsequently will fall, okay, because the price and the yield, they move in opposite directions, okay, as we all know. So with the demand for longer term bonds, the yields will fall. There are many reasons why the longer term bonds, why investors would want to buy so much more of the longer term bonds, okay, but the main reasons are a bleak market outlook, economic worries, potential war in the Middle East. So there's really not just one reason, but a host of reasons, okay? Basically fear, right? Fear in the market has driven investors to buy a lot of long-term bonds. So this has driven the yields down. And as for the short-term rates, okay, these are mainly influenced by the Federal Reserve, okay? If you remembered, prior to the July 31st cut, the first rate cut by the Fed, the Federal Reserve, they were raising short-term rates, okay? They were raising all the way from 2015 until recently. So this has caused the short-term rates to rise to a level where right now the long-term rates have broken downward, okay, and has fallen below the short-term rates. And really, it's one of the most reliable recession indicators out there that many investors, traders, fund houses follow. So some inverted yield curves characteristics. So far, since 1965, we have had 7 inversion cycles, okay, and without fail, recessions have followed after. So that explains the amount of fear, okay, that we have currently in the market. Stocks tend to have their biggest falls during recessions. Let's take a look at the past 3 inversions and see what the history tells us. Now in 1988, okay, in December 1988, we had our inversion right here. The white line represents the inverted yield curve, right? While the green line represents the S&P. So funny thing is that when the yield curve inverted, okay, you see the white line here, that represents the inversion. That means it's dipped below zero. You see how after the yield curve went below zero, the S&P continued to climb. And then it peaked in July 1990. So about 2 years, about 1.5 years later, it peaked. So there's a little bit of a time lag. There's a little bit of a lag, okay? When the yield curve inverts, the S&P continues to climb, and only much later does it trend downward, okay? Because of recession, coming through, and then it starts to trend downward, okay? So we see that there's a little bit of a lag. So let's look at the next one in 1998. Same thing, likewise, in May 1998, we had our, wouldn't call it the first, but we had our inversion right here. And you see the S&P index after the initial correction, okay, like what we had just recently, the S&P actually continued to climb, and it peaked in March 2000. Okay, so we're looking at a lag of about 2 years. So same thing, there's a lag. So let's look at the next one. We had an inverted yield curve in January 2006, and likewise, the S&P index went on to trend higher until October 2007 before it plunged downward. Okay, then we all know what happened. It was the 2008 crisis. But we see once again a period where the S&P actually climbed right after the yield curve inverted. So an inverted yield curve isn't trouble immediately. Okay, we have some data here, right? And on average, typically it takes about 19 months for a recession to occur right after an inversion. So once the yield curve inverts, the S&P does not crash immediately. Now, there may be an overreaction, okay? People start to sell because of fear. But really, the S&P continues to climb, okay? And it takes about 19 months before a recession occurs. And stock peak roughly 13 months, 3 months right here, okay? Later on average. And during that period, they have gained about 21%, okay, over that time. So once, and these are average data, okay, really an inverted yield curve isn't trouble immediately. S&P continues to climb, okay, and on average, they climb about 21%. So historical data indicate that an inversion is an intermediate term buy signal for stocks. Now, yes, a recession will inevitably come and stock markets will crash, but really an inversion is an intermediate term buy signal for stocks. Okay, and with that, we have some ETF ideas that we believe you can consider in view of the historical data shown. Here's some ETF ideas. SPY, SPDR, S&P 500 ETF is an ETF fund incorporated in the USA and tracks the S&P 500 index. The trust consists of a portfolio representing all 500 stocks in the S&P 500 index, and it holds predominantly large cap stocks. This is a non-leveraged ETF, and the expense ratio is 0.095%. Okay, it was incepted in 1993. Next up, we have UPRO, UPRO, ProShares Ultra Pro S&P 500. It's an ETF incorporated in the USA as well. The fund seeks daily investment results that corresponds to triple the daily performance of the S&P 500 index. This is a 3-time leverage ETF. So for whatever gains the SPY or the S&P index have, this ETF will magnify that by 3 times. Next up, we have TECL, the technology sector. The direction that daily technology bull 3 times is an ETF that seeks daily investment results of 300% of the performance of the technology select sector index. Okay, so likewise, this is a 3-time leverage ETF that focuses on the technology companies. Okay, specifically the technology select sector index. Okay, and the last, for some of our participants who may be interested in trading crude oil, you can actually invest in USO, okay, the WTI crude oil. It is a limited partnership incorporated in the USA, and the fund's objective is to have changes in percentage terms of its units net asset value, reflecting the changes in the price of the WTI crude oil. So this is a non-leveraged ETF as well, and what it does is it follows the price of the crude oil. So for some of us who may believe that crude oil will continue to climb because of potential war in the Middle East, you can have exposure via the USO. Please do note that leverage ETFs are not suitable for beginners and retail investors, as the loss may be magnified. Furthermore, leverage ETFs are not meant to be held long-term, as the daily rebalancing will cause the value of the investment to erode over time. Okay, with this, I will hand the time to my partner, Ming Jun. Thank you.
Okay, thank you, Roger, for the market outlook. Right now, I'll be proceeding on to the technical analysis. But for now, I'll be sharing with you another poll. Okay, so right now we are just checking you guys if which US sectors are you currently trading in. Maybe you can just highlight the sectors that you are trading in so that we can have a rough gauge of what to present on in the future, possibly. Okay. So in the meantime, I'll be sharing with you some promotion and features of from us. Okay, and just for you to see right now, actually, if you have not subscribed to our complimentary live prizes, please do so. Okay, and you can take a look at this. You can scan this QR code to get more information on the promotions that we have. Okay, Later, I will be sharing with you a live demonstration on how to actually subscribe to these complimentary live prizes. Of course, it is only available for retail investors, and do take note of that. And also, the next one that I'm sharing with you will be the features that you should know of. It's called the stock analytics, and I think it's very, very useful for investors who want more fundamental information on the counters that they are trading on. The same thing I will also be sharing with you on the live demonstration on how to get the information through our website, through our platform. Okay. And lastly, I will of course touch on the technical analysis portion of the ETFs that Roger actually mentioned. For now, let me just head back to the platform and share with you on where to get the information. Okay, right now, what I'm showing here is our POEMS 2.0 platform. Okay, so I have a list of stocks here that you can actually find on to get the stock analytics information. Okay, so you can just right click on any of the counters that you are looking at. Okay, there's actually this tab called the stock analytics. You just have to click on it. There will be a pop-up window that shows you the stock analytics provided by us. Okay, of course the source is from it is supplied by Thomson Reuters, but information here is quite comprehensive. You can actually take a look. In fact, there is also consensus target price and last traded price. So they tell you about this information. Some simple technical analysis and the financial information can be found here as well. Okay, so pretty useful. Okay, and of course you can use this to help in making your investment decisions. Okay, so that is for stock analytics. Please note that this stock analytics will actually be available only for equities. They will not be available for ETFs. And yes, so right now I'll go through the live price subscription for those that have not subscribed to it. Okay, you can just head on back to the platform 2.0, and under the rewards tab at the top, there is this new reward subscription. Okay, so right here you can see the US live prices. Okay, it is actually complimentary for our retail investors. You just have to click here and fill up the agreement and submit. It should be up in about 1 to 2 working days. Okay, if you meet the criteria, of course. Okay, so right now I'll be moving ahead to the technical analysis of some counters, and probably at the end I will also invite you guys to put in on a question if you want me to share on any other charts that you would like to see. Probably another 1 or 2 maximum because of time limitations. So right now you should be able to see my chart, which is the POEMS Mercury by our POEMS Mercury. Okay, it is a platform, a dedicated platform that you can install and use it with the charting tool inside. It's more comprehensive than our POEMS 2.0 platform. Okay, just give me a moment while I start with it. Okay. First of all, I will be going through with you the U Pro that Roger introduced to you just now. And like all technical analysis, I just give a brief introduction to it. Okay, to me, TA is actually a very art skill. Okay, it's not actually a very hard and fast fact true. Yeah, just it's more of an art than a science lah, they say. Okay, so what I see may be different from what other analysts or any other people, any investors that sees it. Okay, so it may be very different, but I always like to do it by zooming out as a first step, looking at the major trends. Okay, for example, right now, you should be able to see that I zoomed out to 3 years using the standard candlestick charts. Okay, so you can see generally the trend 3 years ago was up. Okay, but right now due to this, what was this? This was a stock split for 3-for-1 and the corporate action. That's why you see it that way. And usually like this, I will actually move in to take a look at the nearer term, okay, to have a clearer sense of it. Okay, so in this leverage S&P 500, 3 times leverage, you can see that, I mean, what I can see here is that there is a strong resistance at the 59 level, okay, but I also can see, okay, you can see these 2 points, they didn't break, so it's quite a good indicator that this is a strong resistance level, okay. And right now I'll try to draw a trend line. You can also see that, okay, this trend line is not that fantastic, but because there's a oversold situation over here, you can see the indicators that I'll explain to you in a short while also will be telling you this thing, okay. So this trend is not exactly very well because it doesn't have this touching the trend line. So in fact, I will not be including this trend line, okay. But you can also use the indicators that is provided here on the platform. Okay, you can see there are multiple indicators here that you can use. But today I'll be just using the more basic ones. Okay, the exponential moving averages, which is a type of moving average that actually places a greater weight on and significance on the most recent data points. Rather than using simple moving averages, we use exponential. I like to use exponential. And there's the 20 and the 50-day 50 periods moving averages. So the general idea is that the one hugging the price closer is the one with a shorter time period. And how you read these two is if they crosses, it signifies a change in trend. But that's the more basic way of looking at it. And you can also use it as a point of support and resistance. Like for example, here you can see that it actually rebounded off the 20 period moving average. Okay, I'll also be introducing you the relative strength index, RSI, over here. Okay, so it's actually a momentum indicator that measures the magnitude of the recent price changes to evaluate any overbought or oversold situations. Okay, so the traditional interpretation is actually to see the values of 70 or above to indicate that security is actually becoming overbought, in the sense overvalued. Okay, and it may be subjected to a trend reversal or maybe a pullback as well. Okay, another way is which is the 30 level, which is your sold undervalued condition, and then you should see a rebound of the price upwards. Okay, that's how you can read it. Okay, right now at the bottom here you can see this is the 70 point level, and this is the 30 point level. Okay, you can see that right here, this sharp movement down actually causes it to cross this 30 point to signify oversold situation, undervalued. And true enough, it actually rebounded off that, and right now we are approaching back to the high set in July. Okay, but because this is leverage, you need to note that the price movement here is magnified. Okay, so any movement will be more than a usual S&P movement. Okay, so that is for the first chart that I'll be sharing, which is the U Pro. Next up, I'll be sharing with you on the TECL. Okay, which is your tech bull 3 times. Okay, same thing. I will head back to the 3 years portion, 3 years chart. Okay, to zoom out, you can see generally the long-term trend has for the past 3 years is an uptrend. Bar this actually very strong sell down. Okay. But we can see that the resistance has actually been broken. Let me just draw here. Okay, so at a 170 to 172 level, right? Okay, when we talk about resistance, we usually talk about range and not a specific price level. Okay, for resistance point, you can see that these two highs, that it was broken by significant price action. I mean price movement in July this year by setting a new high. Okay, And also there is a trend line. Let's zoom in to the past 1 year. Okay. This trend is much better than the previous one. You can see. Okay, so multiple points it touched, and it managed to rebound it off this trend line, which is in fact quite powerful. And if I extend it to the current level, sorry, but the movement is kind of slow. Okay, if you extend it, you should be able to see that the trend, this trend line will be tested once again with, I mean, it's going to test it relatively soon at a 150, 160 level, okay, where a buying opportunity might present itself, okay. So this is for people looking to invest in the tech sectors, where you can actually look at areas of entry, okay. But I'd also note that because the resistance is broken, you can see all this is actually past the high of 170 to 172 level. So we should expect it, the uptrend to continue. This uptrend seems pretty strong. And like what Roger mentioned just now, there's an intermediate buy signal for a yield curve inversion. So likely it may continue the trend upwards. Okay, and that's for tech. 3 times. Of course, you can see the RSI not showing much in recent terms. Recent 2 months is in the middle. So it's not telling us much, but the trend line here is pretty powerful. So you can look into this. Okay. Okay, so the last one that I'll do a quick one will be on Alibaba. Okay, one of the more commonly traded ones. Okay, so same thing. Again, we zoom out, and of course, with the 20 and 50-day moving averages, you can see that we are more of a sideways market right now. And let's take a look. Okay, this 167 level may be place that we will like to have some take note of. Okay, you can see it's actually rebounded quite a few times off this level and also form a support and resistance area. And of course, right now, there's quite a huge movement for the past few months up to this year, beginning of this year, from 130 level. It has been on a sideways market for this couple of months. Okay, but generally, you can see that the lower lows are, it's not giving out a lower lows indicator. Is actually rebounding off sort of a trend line over here, but it's not very clear. You can take a look at RSI for your indicative entries and exit points here. You can see it's quite accurate in the sense here. Okay. And that is all that I'll be sharing with you for today's technical analysis. And right now we will be taking questions and answers shortly. Just give me a moment. Okay, for the next charts, I will of course be sharing back with you this chart, but let's go back. Okay, so right now will be the Q&A portion. We will be answering them shortly. Just give us a while. Okay, so there is this question on comparing trade war, impeachment, and the president election. Which one has the highest impact to the US stock market? And then there's also a follow-up on which factor affects Singapore stock market most. Roger, would you mind answering this question?
Okay, to compare between the trade war and the impeachment of the president, which one has a greater impact? The US stock market. So we are referring to the US stock market. We believe the trade war has a more significant impact, without any doubt, on the US stock market. The presidential the impeachment of the president is just unfortunate distraction at this point. But the trade war, because it affects the market. Okay, so we have this question. Okay, to compare the trade war and the impeachment of the president, which one has the higher impact, okay, on the US stock market? So we believe the trade war would impact the stock market more significantly because economically, it impacts the companies, okay, that are involved more directly than the impeachment of the president. Okay, the impeachment is unfortunately at this point still very early. We do not know if it succeeds or not. So it's just a very unfortunate distraction at this point. But we believe the trade war is more significant to the stock market at this point.
Okay, there is a question here on stock analytics available for other markets, Hong Kong, Malaysian stocks, and UK. Yes, it is available for some of the counters. You should just right-click on the counters and go into the stock analytics. If it's available, you should be able to see information there. Okay, that's for stock.
Okay, we also have another question that just came in. Recently, there's been a sharp sell-off in the gold and the silver miners. So has the trend ended for the gold and silver stocks and for the gold and silver miners? Like all stock markets, they never go up in a straight line. And prior to the correction in the gold and the silver miners, they went up very significantly. So it is a minor correction that was expected to come, because they've gone up so much. So it was expected that there'll be some sort of a correction. But the long-term trend, you have to look at this, long-term wise, the trend is still there. Okay, there's so much uncertainty, and right now with the proceeding of the impeachment of the president, it has added into the mix. It has caused the dynamics, okay, of the entire thing to be even more significant. So we believe long-term trend, gold and silver will continue to trend up, but it's just a correction that was foreseen to arrive. So by long-term trend, it should continue to proceed.
Okay, so the next question, we'll just answer two more questions. Okay, the next question is, will there ultimately be a trade deal from China and US?
Okay, in our opinion, yes, eventually that will be a trade deal. You can almost see it coming. They're currently holding out on agreeing to a deal because it serves a purpose. For example, Donald Trump wants to, be tough on China because he'll be seen to be a tough leader, and the same thing with President Xi Jinping. He doesn't want to be seen losing face. So will there be ultimately a trade deal? I would say yes, but as to when it will arrive, that needs to be seen. We really do hope that positive outcome will arrive very soon. That will really give the stock market a significant boost. So let's cross our fingers and hope that it gets resolved soon.
Okay, so right now I'll be sharing probably from the questions on the technical analysis. Okay, if I will just take a look if which chart that I'll be sharing on. Let me just go back to the chart. Okay, we have a query on Boeing. Let's take a look at Boeing. Okay. So as the same thing that I did from the past few counters, we zoom out to look at the major trends first. Okay, previously back from 2016 all the way to 2018 was a very clear uptrend. but right now it is more of a sideways market as compared to the previous 2 years. Let's take a look at this portion right here. Okay. Okay, this 320 level seems like a major support area, but again, it was broken here. So it may or may not be a good point, but the near term from the August period, there was a support at the 320 level. And of course, they were marked by the disaster from their 737 program. Okay, so you can see that there is also some short-term resistance over at this level, the 380 to 390 region. Okay. This one, we take a look at the shorter term area. And we can see this part is the near term wise, it has actually broken, but we will have to see if this will act as a support area, a resistance turn support for this counter. Okay, generally, I mean, moving forward, I think it is still going to be a sideways market for this counter. And you may just look to identify more support and resistance area. You can see RSI is actually not showing much of as well. So, yep, that will be all for technical analysis today. And so that with that, we have come to the end of our webinar. And okay, so if you have further queries or anything that you would like to ask, we are a team of 4, the Global Markets Night Desk, and these are our contact number. Okay, and that's all. Thank you.